tardes a todos amigos y amigas de Frontal Trust. Espero que se encuentren todos muy bien. Bienvenidos a este último webinar del año 2024 que hemos denominado Mercado Logístico de Estados Unidos, Tendencias, Desafíos y Oportunidades de Inversión. Para esto nos acompañan nuestros queridos amigos de Bridge. ¿Quién es Bridge? Bridge es un asset manager americano que está enfocado, es una plataforma integral que está enfocado en todo lo que es el mundo inmobiliario. En la actualidad manejan del orden de 49.000 millones de dólares y dando soluciones al mercado de inversión y a los distintos tipos de inversionistas. Para eso nos vamos a enfocar en el mundo de la logística, que es una de las áreas que Bridge nos ofrece para invertir, y somos afortunados de tener en este momento a Brian Gagne, quien es el Co-Chief Investment Officer, gerente de inversiones del área de logística, que junto a Jay Comfort conforman un equipo altamente reconocido en el mercado. Ellos iniciaron su carrera en el mundo de la logística norteamericana, eh, manejando esta estrategia en Brookfield, asset manager que todos conocen, y ya hace un buen tiempo ya se cambiaron a Bridge, implementando esta estrategia para Bridge y permitiéndonos el acceso a eso a través de los distintos productos que tendremos a futuro. Bajo es impresionante, solamente para que dimensionen, Brian y su equipo han administrado negocios del orden de 155 millones de metros cuadrados en distintos activos del mundo logístico. Para solamente que dimensionen, un actor chileno, Bodenor Flex Center, hoy día maneja 820.000. O sea, estamos hablando que son personas muy preparadas que vienen hace mucho tiempo haciendo el negocio y que la verdad que lo muestran con un track record excepcional y que conocen mucho este mercado. Y les comento que al final que pueden ir haciendo preguntas a través de este Zoom. Hay un chat ahí habilitado para eso y que al final de la presentación esperamos responderlas todas. ¿Ah? Brian, hello. Thank you very
Hello,
much
Chris.
for being here.
No, thanks for having me.
So I think the floor is yours. So please go ahead with your presentation on the U.S. logistics market and the post-election impact on the U.S. real estate sector.
All right. Thank you for having me today, Rodrigo. It's a pleasure to be here. Before I jump into this presentation, I think it's important to note I am not an economist. I am not a political analyst, but I've been doing logistics investment and development in the United States my whole 25-year career. And I think today we'll talk through the market from my lens. And I think, with a focus on historic data, and why. History doesn't necessarily repeat itself, but in American markets, it certainly rhymes. So let's jump into it. And hopefully the screen is now up. There we go. So what are the key inputs or ingredients to today's world and in the United States and market? And really first, we're going through a cyclical reset initiated by the interest rate reversion. And our marketplace is heavily tethered to GDP and really the American consumer. So, and the big question today is, what is the American consumer's health? How much cash do they have? What does their balance sheet look like? Can they continue to consume? And the interest rate reversion has certainly, limited their capabilities financially, and that's impacting leasing demand. And we'll unpack this a little more later, but that's the first element. The credit markets dislocation. When you think about this, lenders are extremely selective today as they're trying to preserve capital. They were caught a little off guard by the speed of the interest rate reversion. Not all their loan positions are strong. So we've seen them sort of lean towards more stable cash flowing lending than higher risk lending, which creates an interesting sort of mispricing or credit markets dislocation that's impacting all elements of the economy and real estate. The presidential change, I think everyone loves to talk Trump. We'll get into that a little bit in a minute. He's a candidate with inflationary policies that has now re-entered the White House. And to be honest, that's not surprising because the other candidate, they had inflationary policies too. So, but we'll talk about that more today. I think the good in terms of when you look at sort of our marketplace, the secular tailwinds, thanks to e-commerce, is really unique. And we'll expand upon this, but the prime effect, basically same day shipping and its importance to American consumers, has really reshaped and changed the leasing demand paradigms in the US. So great tailwinds to our space. And, because of that, or following that, we've seen significant capital rotation into our space. I mean, you go back a decade, many pension funds, institutions, logistics was an afterthought. It was a nice complement to their portfolio. Now it's the anchor of their portfolio. So the amount of capital that's flooding into our space has really changed pricing a great deal. And then, finally, it's not unique to the United States, but, similar to the UK, we're seeing a lot of headwinds on new logistics development. And why is that? Americans are pretty selfish. While they want same day shipping, they also don't want that warehouse to be in their backyard. And that creates a great sort of pressure or imbalance on the marketplace that benefits me and as an investor, because you basically have more demand than there is supply, and it leads to great long-term value appreciation. And we'll talk a little bit more about that as well. So let's jump into sort of some of the elements of the marketplace. And I mean, first we have to start with interest rate reversion. This is the famous hairy chart where you can see the forward curve at different moments in time. And really the red is the most interesting line because that is the post-election, that is the Trump curve today. So you can see that the line is essentially starting to predict higher for longer, and they return to somewhere of SOFR, the Fed funds rate, to around 4% or high threes. And when you look at that, I mean, the market is basically predicting that the rate environment is going to somehow stabilize to a level that mimics or mirrors early 2000s interest rate behavior, which is when inflation was last sticky in the United States. So let's kind of unpack that a bit. So this is a really busy chart, but it basically compiles everything from
Brian,
Fed funds.
Brian,
Go ahead.
sorry. Yeah, I think that, amigos, yo creo que en este momento, dado que estamos hablando de tasas de interés, hay una pregunta que deberíamos hacernos todos y hacérsela a Brian, que es cómo estas tasas de interés de largo plazo pueden impactar a los cap rates de los negocios inmobiliarios. So, Brian, in an environment of higher long-term interest rates, how does Bridge foresee the evolution of cap rates for logistic assets?
No, it's a great setup, Rodrigo. So, this chart and kind of leads to that sort of conversation where it's busy, but I'm a pattern guy, and what do I pull out of this? Basically from 2009 to 2020, there was no inflation, and why was that? It was thanks to China's production of cheap goods, and really no friction between the U.S. and China during that time. At the same time, there was a zero interest rate sort of policy in effect. And at the same time, there was capital injections that happened in the GFC and then in COVID. So money flew into the system in everyone's pocket. So finally, we had this inflation spike over the last couple of years. Now, when I look at this, and again, we're looking for sort of patterns historically that we can look to kind of predict go forward behavior. It is that early 2000s. So that is when inflation was last sticky. In that time, the U.S. Treasury was in that 4 to 5% range. The Fed's funds rate sort of varied in between, call it 2.5%, and then it spiked up to 5%. But largely was in that sort of 3 to 4% window. And to be honest, that's when I started my career in this space, and that feels very familiar to me. So when you look at cap rates, I think you really have to look at sort of the risk spread in which core comparables traded to the 10-year Treasury. That's the best piece of correlation. And we've studied that. We've gone back in our database 20 years and understand the risk spread and apply that to a Treasury that's in that, call it 4.5% range. So Now, what is the risk? What happens if somehow inflation becomes uncorked to a level that is more aggressive than what we saw in the early 2000s? Well, the last time before that where we had really sticky inflation was the 1990s, when the US Treasury was in the fives, closer, 5 to 6 range. And we actually stress test all our deals at BLP to both sort of the early 2000s interest rate environment on exit, but then also the 1990s interest rate environment upon exit. And if the deal is durable in both those sort of constructs, we're buying that deal because it's good value today. So I'll get into it in a little bit more detail later, but in short, core comparables today or core sales in primary US markets are in that, call it 5 to 5.75 range. That's where we're seeing deals happening. So let's keep moving here a little bit and get to everyone's favorite topic. So let's talk Trump. And we very much know what his playbook is. What is that? It's deregulation, it's tariffs, it's onshoring, and it's tax reduction. So all of those things are inflationary in nature. But let's kind of unpack his politics a bit and understand that a little better. So, Trump really prides himself on economic performance, more so than anything else. I think when he's campaigning, he talks a lot about social issues that are very emotional for the country, but he really almost gauges his performance solely on economic expansion. So deregulation, why does he do that? Stimulates growth, right? That's the first lever he can pull to keep the economy moving. Tax reductions for both corporations and individuals, it puts money in their pocket to, again, grow, spend, consume. So again, he's looking to stimulate. And then, everyone talks about tariffs. And when you go back to his sort of term, his first term, he had very strong tariff language in that term as well. But when you look at the actual tariffs that he enacted, they were very selective. So if anyone's read his books, in terms of the art of the deal, one of his sort of methods is come strong, threaten, big movements, and then retrench and find a deal somewhere in between the parties. And I think that's a great description of the tariffs, is he kind of uses them as a political tool to manage his opposition, his enemies, and his actual execution is very limited or selective. Now, with all that, right, what is its impact on onshoring, on nearshoring? And just to firm up those definitions, onshoring is the actual movement of good production to the US. Nearshoring is that production movement to sort of strategic proximate countries.
Sorry, Brian.
Yeah.
I think that it's good to define some words
Right.
here. Para los que están escuchando, aquí en estas láminas vamos a ver algunos términos que son fundamentales de entender y no tenemos por qué entenderlos si no somos expertos y conocidos en el tema, que son términos como onshoring, nearshoring, global gateways, infill markets. So, Brian, the idea here is to explain to our people here, which means onshoring, nearshoring, global gateways, and infill markets to understand
Right.
better the following slides. Thanks.
Right. So onshoring, that is when manufacturing moves from, say, China to the US, and so that facility moves to domestic and things are produced domestically. Nearshoring is when, say, a production facility in China moves to a near or proximate country for production, say a Chinese manufacturing facility moving to Mexico. Now, when we talk about US markets, we use the term coastal gateways. These are the markets that we focus on, and think of those as large population centers with large port infrastructure where goods flow through those primary nodes or receptors and into the rest of the domestic United States. And when I say infill, think of that as more urban markets, warehouses and marketplaces that are in very close proximity to major population centers like New York City, LA, and beyond Miami. So let's start with what we saw during Trump's first term in terms of onshoring, the only onshoring we saw or sort of expansion of manufacturing in the United States was really high value items. Think, technology, think cars, think Tesla, think, sort of really high value, highly educated jobs. That is sort of the location, sort of the requirements that we landed. Now, when it comes to cheaper goods production, whether that's toys or garments, we did not see any onshoring of that lower cost product spectrum. And where did that go? That's something that we track really closely because it kind of gives you a sort of a hint or an early look at how leasing demand may move across the United States and across markets. And you can see that these two graphs are really, I love these two graphs from the standpoint of, you can see the first line on the left demarks Trump's presidency, his first day of office. And then the second dark line is Biden's. But you can see, and this is the total amount of goods moved by country or area of origin. And you see in the bottom, the dark green is Asia in its entirety, the Pacific Rim in its entirety. And you can actually see that over Trump's term and then Biden's, it really didn't erode much. It's remained pretty constant, grew slightly. Mexico did have some gains, but it was more of a higher single digits over the last, call it 15 years, 10 years. So, what's interesting is everyone has predicted that Chinese production may move. And a logical landing point to that may be, in either US or Mexico sort of production facilities. But the truth is that a lot of Chinese production stayed in the Pacific Rim, and you can see it stayed in Vietnam, Korea, Taiwan. And those markets, as they've grown, they use the same trade lanes to the United States as China does. So are we worried that LA demand for logistics space is ever going to decrease because product is moving to different production locations? No, it's actually maintained. It's remained sort of the same course. So it's a really interesting analysis. It's something we watch. We update this monthly to again understand any movers and how we may have to adjust strategy accordingly. So let's go to the next page and sort of transition to leasing. So what is different about the US today than say 10, 15 years ago? It's really this e-commerce tailwind that we talked about. And if you're trying to understand this, the American consumer is incredibly impatient. And they've had accelerated adoption into e-commerce because we have a younger population. COVID actually helped some of the older generations jump into e-commerce adoption. So we have this great acceleration in use. And we have this impatient consumer that 70% of people that go online expect same-day shipping today. Of that group, 40% of them will terminate a purchase if they can't get that item the same day. So that's terrifying for retailers. Retailers are now having to rebuild their entire supply chain in order to get product to people's homes in a matter of hours and not days. And to provide a description of that, historic supply chains, it was okay to have a warehouse 300, 400 miles from a major population center, and product was able to get to that person's home or a retail store in 2 to 3 days. That was fine. Today, that same warehouse needs to move to within 15 miles of sort of the dense coastal population, and it needs to be able to deliver product to that person in a matter of 3 and 4 hours and not days. So that has forced companies to rebuild their supply chain in order to do that. So our markets all of a sudden have all of these retailers basically building out more warehouses and in closer proximity to where people live, benefiting the infill markets that we focus on. And you can see here that in the data where, from 2000 to 2009, and then when you compare that against 2010 to today, you can see the 50% increase in activity from that e-commerce growth. And it's not all rainbows and unicorns. Today, as I mentioned, leasing demand is slowing. It's probably down 20%, as you can see in the right-hand bar from peak, but that's okay. That's still 20% above pre-e-commerce averages. It's healthy. And what does that reflect? Every time we have an economic cycle change, there's always a knee-jerk reaction that retailers, logistics companies have where they take a defensive posture, they spend less, they don't expand, they sort of try and handle product and inventory within the capacity they have in their existing supply chain footprints. But then you can always see there's a quick snapback once there's better visibility in the health of the American consumer and the go-forward economy. And what are the best examples of that? You can see 2001 and 2002, sort of the drop and then the snapback. You can see in 2008 how from 07 to 8 and then to 9, that recovery. So we're in the middle of that change, and it's, we're still have very healthy fundamentals that we'll talk about, but that's a little bit of sort of that push, that e-commerce push that's changed our market. All right, so we talked a little bit about the e-commerce adoption. This just further shows that. One thing that's really important in this, everyone always asks, like, what is the future prospects of e-commerce adoption in the United States? And I would say we're still very early innings. So, while we're kind of in that high teens adoption range, when you go to the UK and you go to China, you can see populations that consume much more via e-commerce, and you can see where we're heading. I mean, when you go to China, it's amazing. Everything's done on their phone and everything's digital. And, it very much is an immediate sort of distribution marketplace. And I think that there's a lot of growth that's going to be had in the US with our sort of population sort of dynamics. And then one other interesting thing is people always ask, well, rents have really grown in the US in the logistics space. Is there an affordability cap? And we kind of talked about the importance of same-day shipping and how it's threatening companies' revenue lines, right? Now, when you look at the actual real estate cost of supply chains, it's this small piece of the blue primary pie chart here. I mean, it's less than 6%. So the cost of real estate is low. The cost of transportation is high. So if you move those warehouses closer to where the population is, there is flex, there is ability in the tenancies to pay a premium for that space, in order to be able to reach these customers. So, we've yet to see an affordability cap ever restrict sort of our last mile spaces and the rental growth trends that we've seen over the last decade. Another interesting element of e-commerce is that, many of you all probably read about in business school just-in-time inventory and how genius that was in prior years. Now, e-commerce has changed that, where if you don't have a product in your inventory on hand, as we talked about, you lose revenue. There's a chance that some online customer comes online, you don't have it available, it can't be delivered to them in the next day, and they just move on to another brand, or they just don't buy that thing altogether. So all of a sudden we've transitioned into just in case, and it'll be really interesting to see long-term how this impacts sort of demand and inventories, but I expect to see sort of this trend grow in terms of inventory ratios. You can see the fall in that 2020 time period at the right-hand side of the chart, and that was really COVID. That was the product of, supply chains were disrupted, people purchased a lot of the inventory that was on hand, and we got down to a level that was just unsustainable in terms of inventories, and they've been trying to catch up ever since. So another thing that's providing some tailwinds to our space. So let's, okay, sorry, Rodrigo, were you going to ask a question there?
Yeah. En esta lámina vimos una dinámica del mercado, que es el cambio de una transición de just in time a just in case. Esto yo creo innegablemente tiene que tener algún cambio en la estrategia de almacenamiento de los grandes retailers, bueno, y de la gente de los distintos operadores, por lo que Brian estaba mostrando en estas láminas. So given the transition from just-in-time to just-in-case, how is the storage strategy of large retailers and e-commerce operators changing? And what are the implications for demand in logistic space, Brian?
Yeah, I mean, we talked a little bit about it, but you can see the upward trend in inventories. That is only going to grow as sort of e-commerce demand and expectations of same-day shipping grow. You can see here, and this is a statistic, I believe it's from, it was mentioned by Prologis on their most recent earnings call, even a modest amount of inventory growth, whether that's 5 to 10%, could result in another 300 to 500 million square feet of additional space needs in the next 2 to 3 years. So you can see that this is another nice tailwind where companies need more goods on hand in order to ensure they don't lose revenue or miss sales. And you can see the impact of the inventory as it grows on the demand for logistics space. So let's transition to the market fundamentals. And I do want to footnote that this slide, when you look at the data, this is from NCREIF. So think of it as institutional ownership data. And the long-term occupancy trends that we're seeing in our space. And you can see the drastic change from, call it 2000 to 2010 behavior in the green line of industrial logistics occupancy. And you can see how tight our markets are from 2016 forward. It's really sort of, and it's because of those demand tailwinds and sort of the caps on supply in some of the markets that we focus in. Keep moving here. So this transitions to, this is the national marketplace. And what you can see here on construction starts and vacancy, post-COVID, we had 110% increase in spec construction. Now that wasn't universal. That was, there's certain markets became oversupplied, certain markets, there was a modest amount of deliveries, and we'll talk about that in a second, but you can see that growth. And with the slowdown in leasing, you can see on the green line how vacancy has had an uptick to about 7% nationally. Now, that being said, you can see the construction starts falling dramatically. They're down 65% from peak. That is close to our obsolescence factor in the US. And you can see how the vacancy growth in our space is decelerating. So we feel like we're getting to a point where it's a bottom-like moment where the oversupply will be absorbed and we'll get back to more healthy conditions. But when you compare this against historic, vacancy levels, you can see that we're 300 basis points better than what we endured in the GFC. And why is sort of the construction starts down? It's a combination of a lot of things. Construction lending has dried up. A lot of equity has moved more risk off, more focused on stabilized positions. There's dwindling land supply, and there's political headwinds on new development. So there's a lot of elements pressuring that. And so it feels like we've had a reset, there's a floor forming in where we are today. So let's go and break down the construction pipeline a little bit. So when looking at this chart, there's a lot here, but basically what we're plotting is sort of the construction pipeline underway against how large is that as a percentage of the existing inventory of that given market. And when you look at the dots and the lines here, our core markets at BLP are highlighted in green with the blue diamonds. Our non-focused markets that we do not invest in are in gray with the red diamonds. And what you can see is we focus in markets where it's very hard to deliver product. That's where we see the most durable demand, the most durable performance, and with explosive upside, because there aren't supply waves that undermine sort of your rent and leasing outcomes. And and you can see here that, as we talked about earlier, the deliveries are not uniform across marketplace. There are certain markets that are well oversupplied and have massive supply waves forming, and I would not invest there. Like a great example here is Phoenix. And that's a massive population center, but you can build as far as the eye can see, and supply waves can form, and that could lead to a really bad leasing outcome. Meanwhile, you can see the markets we focus in, the supply waves underway are less than 2% of the total inventory. So much healthier backdrop.
Amigos,
Yeah.
sorry Brian, amigos, yo creo que es el momento de preguntarle a Brian cómo él y su equipo pretende hacer esto, dada la consolidación del mercado y por supuesto lo que también ocurre en otros países, la escasez de activos como terrenos, tierra, etcétera, bueno, etcétera.
Right.
Brian, with the increasing consolidation in the logistics sector and with all the attractiveness that the sector has, how is going to do reach to implement the strategy?
Right. I mean, so what we focus on is we focus on markets that are major population centers with density, right, and consumption power. We focus in markets that have really high barrier to entry supply backdrop. So it's hard to deliver new product. And then we also focus on those markets that have great institutional liquidity. Now, when we evaluate markets, that's sort of our primary decision point. So, as an example of that, Phoenix, as I kind of talked about a second ago, it's a very large MSA. It has, it's growing, it's sizable. There is a logistics space need there, but it's really easy to deliver new product in large supply waves form. So even though there's good tenant demand, there's good flow, the supply waves that could impact that marketplace make it uninteresting to us because again, it can lead to a bad leasing outcome somewhere along our hold because supply will undercut rents and they'll be eroded, as there's competition for users. So we over the last decade we haven't done much in Phoenix at all, and that's a choice. Now on the flip side of that, go ahead, Rodrigo. Sorry.
Yeah, and as Bridge is an integrated platform, do you have different sources of assets to buy? I mean,
Yeah.
you have brokers, for example, to find good prices to buy the assets that are on the market.
Right. So what we do, a little bit of our sort of, and this is a strategy that we've implemented for 25 years, both Jay, my partner, and I, where in the infill markets. And really what we do, our secret sauce, is that we build local teams. So we have offices in Southern California, Miami, Dallas, New York, New Jersey, and Atlanta. So our key markets. And in those offices, we have fully vertically integrated teams. So not only do we have investment professionals, but we have asset management, we have construction and entitlement. So all the disciplines are there and local. So what does that allow us to do? We're truly investing in our backyard. We also have the expertise where as we find assets that are somehow complex, we can quickly price them correctly. We can quickly sort of bifurcate what is real versus perceived risk and make smarter decisions. Our sourcing strategy, we don't spend much time with capital markets agents because in the US, once a building is fully marketed through a capital markets agent, the competitive bid is so strong, there's no value left. So what do? We do a lot of meetings and networking with private building owners, with users, with leasing agents in the marketplace to get in front of tenant movement and get in front of deals before the market does. And what is one thing that's unique in the United States, is like a lot of people would assume that 70% of the market is institutionally held in LA. It is not. It's actually the opposite. 70% of that marketplace is owned by users and private investors and family trusts that have maybe owned that real estate for 2 to 3 decades. They probably mismanaged it in some way. They are having a hard time getting liquidity today or refinancing. So we're seeing a lot of opportunity to buy from non-institutional counterparties off market and really add value and build a portfolio and enhance those assets for an institutional exit. So
Excellent.
hopefully that was good, Rodrigo. So I talked a little bit about this, and it's important to note, and it's interesting to note in the US, in the markets we focus in. So like think mature MSAs, whether that's Boston, New Jersey, New York, Los Angeles, Miami. even now some elements of Dallas, these infill markets are seeing political candidates, whether it's at a city council level, it's some sort of representative level, it's mayors that are being elected on anti-warehouse platforms. And what do I mean by that? There's been so much logistics growth in terms of development over the course of the last 10 years. All of a sudden, the citizens, the populace has picked their head up and says, I don't want that warehouse in my backyard. I'd rather it be someplace else. So we've started to see different municipalities, different townships, different cities start to implement more restrictions on new development. And this is a fantastic thing for me and what I do, because we know how to find assets, existing assets, and buy them within corridors that have grandfathered zoning. And then we're also a really sort of, talented development shop from the standpoint of we know how to entitle in complex jurisdictions and sort of build product while other non-specialist, other out-of-market developers and investors will have a hard time penetrating. And so I love this. It's like economics 101. When supply is constrained and demand is growing, our long-term value prospects are incredibly strong. But it's something to keep in mind in terms of the US is that this is a growing movement that's only getting more and more momentum. And a great example in California, this AB 98, this was signed into law overnight with almost no warning. And it essentially impacted 50% of the land sites that we pursued in 23 and 24. And it limited sort of coverage, it limited loading positions, it limited all sorts of elements. So it's amazing to watch this grow. And I think it's going to create a really interesting sort of pressure on value in the infill markets. This is just another slide showing sort of the difference in sort of our coastal gateway focus and supply versus non-coastal gateway markets and how it's really hard to deliver product there. This is really interesting too. So like, we talked about this, a lot of people, there's this misconception that bigger is better in the US. If I build a 1,000,000-footer in Kansas City, it's going to lease to Walmart. And that's not a true statement. Some of the best health and fundamentals are found in the infill markets, in the smaller buildings, because the heart of tenant demand in the urban or infill markets is in that sub 150,000 foot space. And you can see that here, over with the 3.5% vacancy compared to some of the larger sizing. And then also, in LA, much of that marketplace is older vintage. It was built out in the 70s and 80s. And there were those buildings were configured for aerospace and manufacturing. Distribution companies have figured out how to use those in order to reach the population and be in close proximity to the port. So we just wanted to sort of, this underlines the importance of infill focus, and that doesn't always mean a brand new construction 1,000,000-foot building will be successful. So,
Brian, sorry?
Yeah, yes.
Yeah. Well, post-Trump elections, everyone is hearing about tariffs and commercial war between the States and China.
Right.
What do you think that the implications of these changes or this potential war?
Yeah, I mean,
let me traduce the question, please.
Yeah.
Amigos, no, lo que le pregunto, todos hemos escuchado post las elecciones de Trump, que parte de la estrategia de él es el aumento de las tarifas de importación y por ende la guerra comercial que estaría abriendo con varios de sus países competidores. Entonces le pregunto a Brian cuál es el efecto de eso en esta estrategia. Okay, Brian.
Yeah, I mean, as we touched upon earlier, I think, again, he has tough tariff talk. His actual implementation or execution is selective. I think, he's going to use that to control his opposition and enemies. And, I think he's going to be very careful with it because he knows that if he's too aggressive, if he implements it on a wide spectrum, it's going to hurt the American consumer. And that's the last thing he wants to do. He wants continued economic expansion, and you can't do that when the American consumer is injured. So that's my take. And so I think, those tariffs that maybe he does enact in order to, show some strength, I think you're going to see much of that production, if it does leave China, rotate through the Pacific Rim. That's what we've seen historically. That's what we've seen to date, which leads to the same trading lanes, to the US. Now, I'm sure many of you are like, well, isn't NAFTA now up for discussion again in 2026 with Mexico and Canada? And the answer is yes. And you can see the trajectory in his dialogue where he's being uber aggressive with Trudeau. He's being uber aggressive on the potential tariffs that he'd apply to both those regions. I think he's searching out for a better deal. So I think you'll see with time, he'll be searching out that meeting point to better the agreement that's in place with those two parties. And this is the beginning of that negotiation. So hopefully that helps, Rodrigo. So on the industrial liquidity, I mean, I just wanted to show, like, when my career began, I remember, this is 20 years ago, being at an annual investor meeting, and this massive Dutch institution, investor walked up to me and said, listen, I don't even consider logistics as part of my real estate allocation. You go into my miscellaneous bucket. That is completely flipped on its head from the standpoint of now logistics is 40% of some pensions real estate portfolio in the US and globally. I mean, this is truly the space in which people look at the most durable long-term demand tailwinds. And, that liquidity is rushed into our marketplace. And, what that has done, what's interesting about it, when you think about our space, the transactions are small. There's few experienced operators. So if you can build the right portfolio with geography, product mix, tenancies, average remaining lease term, then you can create a significant portfolio premium on exit. Now, we don't underwrite to that. We underwrite every deal on a one-off basis. But I will tell you, when at my time at Brookfield, when we chased the $19 billion GLP transaction, IPT, Colony, all the big deals, really the buyers of those larger portfolios do not inject the same real estate underwriting discipline as we do in our acquisitions. And there is a spreadsheet or portfolio premium if you can build it right. So sort of building on that, just switching to the REITs real quick. This is always like a metric or an optics that we watch. The most interesting comparable relative to our business is Terreno. They operate a very specific coastal gateway strategy, like us, infill, and you can see their occupancy at 97%, and you can see the implied cap rate that they're trading at a 4.4% range. And I think what that does is it underscores the appetite for logistics exposure in infill markets, and how our strategy has great upside potential upon exit. So let's get to the sort of fun stuff, which is asset pricing. And it's funny, whenever I travel internationally and I share where core assets are trading in the US between, call it 5 and 5.5 cap ranges, people are always floored. And really, why is that? I think it's that rotation of capital into this space. But then also what's been really interesting over the last 12 months is, while there's been a credit market dislocation, the stabilized asset financing has seen spreads compress. So when you look at 40 to 50% leverage points, lenders are actually quoting risk spreads that are sort of neutral for core plus investors. It isn't negative leverage anymore. And remember that most of those loans are based upon, they're tethered to the underlying treasury in terms of its duration. So, and they're not SOFR based or Fed funds based. So, it's really interesting to see, because that then supports these core buyers to go out and buy deals at 5 caps. And with modest rent growth over their 7 to 10 year hold, they can still make their 9 to 11% leverage returns with that debt backdrop. Now, on the flip side, when it comes to value add deals today, it's a much different spectrum where risk spreads have flexed out. They're wider. So you have to be really careful with how you execute on your leverage and strategy, because lenders are very selective on sort of the higher risking deals. And hence, when you look at the pricing that I am seeing in marketplace, from my standpoint, I am buying deals in LA that I can stabilize to a 7 yield and then sell into this 5 cap core exit once I'm done with my business plan. That's 150, 200 basis points of arbitrage, which allow me to create high teens leverage returns. And why am I able to find that 7? It's one, I'm able to source deals off market. 2, I have the ability to improve NOI through improving the building or sort of correcting a mismanaged asset. But also the risk spreads have blown out on risk because of everything that we've just talked about. The reversion in interest rates, the softening of demand, the transition in cycle. So it's actually a very exciting hunting backdrop for us. In this vintage of fund, it is exciting. So I kind of talked a little bit about this, but sort of continuing that. So, you know, when you think about the fund vintage today, you have good fundamental backdrop, even with the demand reset that's happening today. You have these credit market dislocation that's impacting private owners and users. So we're sourcing from weakness. We have strength or stability in our fundamentals, but then on our exit, we have incredible core strength and interest. So I love that backdrop. Source and weakness, execute in a decent marketplace, then sell into strength. Now, that being said, it's going to be a different environment from here forward. If you look at myself and all my peers, we all have the same track record over the last 10 years. If you didn't make money in the logistics space in the United States, you should have got out of it. Now, from here forward, I think our track record is going to be very different. And that old Warren Buffett saying, you're going to see as the tide pulls out who is swimming naked, you're going to see who's very good at asset selection and sourcing and who's not so good at that. So really, you know, the sort of what I'd stress is, or what is paramount, is asset selection. You have to be very careful with where you take risk in this environment. But if you do take the right risk, it almost, if you're comparing against the GFC, it's not as opportunistic moment as 2009, 2010, but it carries less risk. So we're super excited about this vintage of fun, this vintage of wine. So, and then on this last slide, you can kind of see what that translates to for those that are interested in terms of economics. And we used a development deal, and you can see here that, you know, land values are, the pricing is actually reduced by about 50% across markets. And again, what's driving that? It's the interest rate reversion, it's the widening of risk spreads. But what's exciting about this is if you can select the right projects in the right markets, getting back to an untrended development spread of 150 basis points is what sanity is. I mean, that's what I remember from early in my career. What happened over the last decade is with the zero interest rate policy, people were taking on development risk at 40, 50 basis point spreads untrended, which is insanity. It's inappropriate because development carries risk on construction, entitlement, everything. So it's an interesting moment where, again, if you can be very careful with where you take risk, you're going to be rewarded over the long term. But maybe I pause there. We get some time for questions, Rodrigo, and we can kind of see where the conversation goes from there.
Yeah, thank you very much, Brian, for your presentation. Antes de seguir, como les dije al principio, hay un chat para preguntas y ahora vamos a empezar a leer las preguntas que hemos recibido, pero antes de empezar con eso, me gustaría comentarles que este año 2024 para Frontal Trust ha sido un gran año en varios sentidos. Especialmente hemos logrado lanzar 5 productos, siempre en el mundo inmobiliario de la banca privada, de deuda privada, perdón, y en el mundo alternativo, en los cuales hemos logrado suscribir en su totalidad y con mucho éxito tanto en clientes privados como en clientes institucionales. Así que muy contentos por eso. Adicionalmente a eso, hemos lanzado una nueva área de negocios que es nuestra área de agrobusiness y dando el resultado a nuestros clientes con todos nuestros fondos con muy buen performance en términos de rentabilidades y lo que hemos prometido. Ahora, para finalizar, vamos a ver preguntas de ustedes. Sobre ¿por qué el sector logístico ha demostrado ser un refugio atractivo frente a otros tipos de activos en periodos de alta inflación y ciclos económicos desafiantes? Logistics sector resilience. Why has the logistics sector proven to be attractive, haven't compared to other asset types during periods of high inflation and challenging economic cycles? Brian.
Yeah, I mean, when you look at sort of the spectrum of other offerings, I'm sure the audience is well aware of some of the stresses, but in the US right now, office obviously has a demand problem. You look at multifamily, they have a supply problem to an extent. Retail is trying to figure out what it is in terms of its identity moving forward. And then when you look at logistics, we have great demand tailwinds, secular tailwinds to our space. We do have supply constraints in sort of the infill markets that we focus in. So you're seeing not just contractual rent bumps that are built into our lease. And by the way, in the US right now, contractual rent bumps range between, call it 3 and 4% is marketplace. That get up as high as 5% when the market was at peak. So there's natural contractual bumps. At the same time, there's also long-term rent growth because when you think about a lot of our lease durations, they're 5 to 7 years, or 3 to 7 years. So there's these mark-to-market events that happen over people's term. And with that supply-demand imbalance, there's going to be further rental growth. And as we described earlier, there is no affordability problem relative to industrial leases in our marketplaces. There is users' ability to absorb rental growth because they have to deliver to same day and to these difficult to reach coastal populations. So it has great backdrop. And then also you've seen investors now compress risk spreads in our space to levels where in LA, as we talked about, core pricing is 50 bips over the respective treasury. So there's a lot of things to like, and there's a lot of things to like about the total return offered by our space long term, especially in an inflationary backdrop.
Excelente. Para carteras de largo plazo. Tenemos una pregunta nuevamente referente a las tensiones con China. La que dice, con la probabilidad de una relación más tensa con China, ¿cómo anticipa Bridge que el mercado logístico responderá a un posible cambio en los flujos comerciales hacia hubs regionales en América del Norte? Trade tensions with China, with the likelihood of a more tense relationship with China. How does Bridge anticipate the logistic market will respond to a potential shift in trade flows toward regional hubs in North America?
Right. I mean, as we talked about earlier, we closely watch the origin of import goods on a monthly basis. We're always looking for shifts in the trade lanes because it then predicts sort of how demand may move from New Jersey to Houston or California to elsewhere. So when looking at history, when looking at the last 15 years, that production that China lost was largely absorbed by the Pacific Rim. You can argue that some of that went to Mexico, but the majority of it was absorbed by the Pacific Rim, which is the exact same sort of trading lane to LA. So we haven't seen a movement in production in terms of that erosion from China to markets that would make us reshape our supply chain footprints immensely. We are watching Mexico. I think there's certain product that has moved there. I think the movement of that goods north into the U.S. will benefit certain Texas markets. We would never invest in the border markets because no one lives there. There's no durability to demand. It's sort of singular and very binary in nature. We would rather make investments in Dallas and Houston and Austin, major population centers, where sort of that good movement north of Mexico is additive to demand. And there is a durability to leasing there because of the people that live in proximate. So that's what I think on that, Rodrigo. And we've hit on that, but that is what we've seen, which is shocking to many because people immediately assume that onshoring and nearshoring was material over the last 10 to 15 years, and it wasn't. It was a little bit overhyped. So.
Ok, una pregunta muy buena. ¿Cómo no considerar el riesgo tecnológico en este ambiente que estamos viviendo? La pregunta es la siguiente: ¿cómo incorpora Bridge la automatización y otras tecnologías emergentes en la configuración y diseño de sus instalaciones para evitar la obsolescencia? Brian, in nowadays dynamics about technologic risk, the question is the following: how does Bridge incorporate automation and other emerging technologies in the design and configuration of its facilities to avoid obsolescence?
Right. I mean, the biggest for us is clear height on new development. You know, the new standard is 40-foot clear. And why is that? A lot of the e-commerce companies have multiple mezzanine layers or pick levels. So the higher is the better, because then they can put in more product into that space. I think at the same time, but more importantly, from my perspective, long term, it's power. Like, if your development sites and assets have unique proximity to certain substations, power providers, redundancy, even more reliable forms of power, nuclear is one, there is a premium that is going to be paid for that real estate long term. And also proximity to fiber is really important, as well as it's sort of our systems become more advanced. And, you know, I think when you look at the warehouses, our warehouses have been largely static over the last 3 to 4 decades. You know, they've stayed the same in terms of their functionality and design. And I think there's going to be a huge evolution in the use of AI, in inventory handling systems, et cetera, from here forward, which really underscore the importance of power and fiber moving forward.
Aquí hay una pregunta que se podría relacionar con la anterior en términos de nuevos modelos de almacenamiento. Brian, I can connect the following question with the last one that you answered. Do you see new storage models that you can tell us?
Well, I think the next iteration for a lot of groups is, you know, it's inventory handling systems that are largely robotic and are uber efficient. And that when our time at Bridge, when we had really large venture capabilities, we saw a lot of different iterations of that. And it's coming. Like in the US right now, we're still very labor intensive. There's a lot of people within these warehouses picking and then putting product into a truck that's then heading out for delivery. I think the robotic advancement, the AI advancement over the course of the next few years is going to be the next evolution in our space. And there's different groups playing with that. I mean, Amazon's always been playing with it. You know, Walmart's always been playing with different sort of fulfillment strategies, but all of it is looking at providing efficiency. It's moving product faster with less movements, less labor intensity, and it's coming. So.
Una pregunta fundamental para este negocio, como otros de infraestructura, es la relacionada a la capacidad actual de tomar deuda. En ese sentido, la pregunta que le vamos a hacer es cómo están los bancos americanos hoy día en términos de su voluntad a apoyar a Bridge en estos negocios. Brian, the last question is about leverage. What is the appetite and willingness of banks and other financial institutions in the US to provide financing in the logistics sector, to Bridge especially?
Yeah, I mean, I think when you think about the leverage environment on the value add side, so a lot of the portfolios we're buying, there's vacancy, there's near-term roll, there's some element of a value add strategy and risk being taken. You know, there's still great liquidity today. It just has two paths. There's a lot of depth to a 50% leverage level, where we could probably get that for a 250 basis point spread over SOFR. Which is very functional for us. And we're an NOI builder. So we don't need leverage to manufacture our total returns. We just need a functional leverage environment to go out there and execute. So we've been doing a lot of 50 to 55% debt execution. The other element avenue of execution today for the value add space is the debt fund world is flush with cash. And what is their playbook? They provide 60 to 65% leverage, but it comes at a cost, and it comes at 350 over, give or take. So when you look at that, that's super expensive debt. Like it's an 8% coupon, and we have to be very careful with where and when we use it. And to be honest, we haven't been using much of it. So that's a little bit of the backdrop in the value add space and the sort of the leverage in its pricing. And again, with our strategy, we are not financial engineers. We just need a functioning debt environment during our business plan and execution. And then after we stabilize the assets, that's when we transition to a much deeper pool today. There's a ton of liquidity and the risk spreads are really tight, and we can get efficient debt in that 60 to 65%, but on a stabilized NOI construct.
Ok, very interesting questions, muy interesantes todas las preguntas. I think that estamos terminando ya. Muchas gracias por su participación. Si tienen algo más que preguntarnos o algún interés por saber más de Frontal, a través de nuestra página, ahí tenemos cómo llegar y contactos a distintos ejecutivos comerciales. Brian, thank you very much to be here.
No, thank you, Rodrigo. Thank you to the Frontal team.
And desearles a todos unas muy felices fiestas con sus seres queridos y ya estaremos pronto en contacto. Nos veremos ya el 2025. Ok, Brian. Thank you.
Thank you all.